What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies, and if you stick with me towards the end of the video today, I've got 4 additional trade ideas to share with you, so definitely stay tuned for that. 2 quick reminders. First one is that the market will be closed on Monday in observance of Memorial Day, and then secondly, as always, any of the resources we are associated with are, of course, linked down below in the description. Without further ado, let's jump right into the charts. Kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this week, we certainly have a solid green-bodied bar, a little bit of a lower wick here, but it certainly pales in comparison to the size of the overall candle body. The other thing I would point out is that there is no upper wick on the weekly bar, indicating that the buyers were able to close prices at the highs of the weekly session. So from a structural perspective, I certainly would give the upper hand to the buyers. From a location standpoint, we do have a bar-to-bar higher low and a bar-to-bar higher high. That, of course, also falls into the bullish category. If we scrunch up the chart just a little bit and remind ourselves of our head and shoulders pattern, how did we close in relationship to the neckline of the pattern? Certainly above that neckline. Remember that we had 2 weeks worth of price acceptance underneath, and now we've negated some of that with a candle close above the neckline. This is a bullish implication, but I don't want you to just automatically assume that it negates the head and shoulders pattern. There's still 2 possibilities that clearly produce a lower high and keep us in a weekly downtrend, right? The first one would be an immediate reversal to close back down underneath the neckline. That would be the most bearish outcome. And then 2, just from the weekly trend perspective, this certainly is not a higher set of lows from here. It, of course, is a lower low. And from here to here, we have a lower high. So we do not yet have a higher low that could qualify the weekly uptrend starting. And we do not have a higher high until we can breach this level in here, roughly 460, to qualify a weekly trend change either. So there's a lot of work to be done before we can say the weekly chart has been repaired in the grand scheme of things. I just want to keep things realistic. Sure, in the short term, things are pointing to higher, but overall, there's still quite a bit of work to be done before the weekly trend changes. The last thing I want to point out is, if we remember, I have pointed out in the past the weekly volume profile. As we were coming into this set of lows right here, I was of the belief that this high volume node would provide some support. Well, it certainly did, but on the way back higher, note that we're headed right into another high volume node right here. It's a little bit higher, I'll give you that level in just a second, but it's pretty typical for a market to move through an area of low volume, so this area in here, the indent in the volume profile, with relative ease, and then stall out at an area of high volume, aka a high volume node. So just like this acted as support here towards these lows, this could very easily turn into resistance up here on the back test of this breakdown point and now offer some resistance around that level. Just to give you the numbers, it's roughly 417.65. We'll see that on the daily time frame in just a moment. Let's go ahead and drill on down to it now, actually, and start talking about tradable levels into the upcoming week. Excuse me as I just pop our study set and levels back on the chart. The first thing I would point out about last week's trading action is, of course, the fact that we saw a move outside of the weekly expected move. This week's expected move is the gray box here, but if you remember last week, here was the week's close. Our week's high expected move was somewhere in here, and the week's low somewhere down here. Notice the close of this past week was roughly a full standard deviation outside of the prior week's expected move. And because of that, you could start to say, roughly speaking, in quotes here, I use this term very lightly, the market is slightly overbought. There are a number of other things, not only that weekly high volume node, but other things as well we'll take a peek at from a tagging up perspective on the market profile in just a second, that would also say the market is getting slightly overextended to the upside. Have we gone too far too fast in a short period of time? Maybe, and I do think that the market could be in store for a little bit of pullback here. So nonetheless, the weekly expected move upcoming, the high end, is tying in with our daily 50 SMA. That level is just underneath 428.75. To give you the hard number, it's 425.65, and also roughly speaking, the top end of this balance area from right around in here. If we do see upside on the week, that would also mean breaking the primary resistance trend line coming from the last rally we saw mid mid-March. So to me, a lot of things stand in the way of the chart just cleanly blasting up through this and getting roughly closer to that 430 area. We did happen to break this resistance trend line, which again is a step in the right direction in terms of making this a true bottom. And I would also point out from a pattern perspective here, we have a double bottom and we've clearly closed above that neckline. So a couple of key objectives. If this chart is going to remain bullish, if this truly is going to be the bottom here around this 385, a couple of things have to happen. First of all, any pullbacks want to now respect the neckline of that double bottom around 405, and of course that would produce a higher low here on the daily time frame. Again, on the weekly time frame, it would be a step in the right direction of starting to form a higher low there as well. So 405 will be critical support as we move into this upcoming week's worth of trade, and notice also it's perfectly aligned with the low end of the weekly expected move. So overall, I do think the market could move a little bit higher because momentum is clearly up right now, but I wouldn't be overly aggressive looking for another massive leg of continuation higher. If we do get pullbacks, again, we've described why 405 is such a critical number. Let's go ahead and talk about market profile now, and again, why the market might be a little bit ahead of itself here. The first thing I would point out, so on Friday's session, we did print a little bit of a spike into the afternoon, indicating that the buyers might have gotten a little ahead of themselves here. Notice the point of control was left in the midpoint of the profile, and we have really thin structure up here at the highs. Because of that, if we start to see any pullback early on in this upcoming week, I would first start to target this area around 4130 or roughly 413 in the SPY as a downside target. Anything underneath that, of course, we're talking about 4050 here in the ES, which is the equivalent to that 405 level of support that we pointed out on the SPY itself. So that is in reference to the spike we produced on Friday. The second reference would, of course, be that we have multiple points of controls that have not been tested yet. So the pullback, there really was no pullback on Friday, obviously, but we opened above the point of control from right here. That would mark this as a VPOC or virgin point of control. Usually you don't like to see any more than 5 of these, even 3 starts to become a little bit much, stacking at any given time. This one was tested, but again, it was just the opening print and then it was off to the races. So I would still sort of classify this as a virgin point of control. It certainly was not tested as a critical area of support. Instead, the market just rallied right off of it on that Thursday session. If we continue to look left, here is another one. So that gives us 3 virgin points of control. And here is a fourth. Notice that this one was left low in the profile. And then even if we go back a little bit further, I talked about this in the midweek market update on Wednesday. This is a really concerning low. That's a poor low. And the point of control was also not tested as we moved forward through time, indicating 5 virgin points of control that have now been stacked here on the market profile. Does it mean the market has to collapse and come all the way back down to this level? Absolutely not. But it's just an indication that the market's not really getting give and take. It's all take right now from the buyers. And if there is any sort of pullback, we should start to target some of these areas as targets down below. So that is our market profile. Thanks for sticking with me through that. Let's get into some sectors now and start talking about where there's relative strength, weakness. Are things improving for a more risk-on look in the marketplace? Energy here continues to scream to the upside. Remember that this is not really the look that we want to see for a better market bottom here. Sure, upside pressure is good upside pressure for the S&P 500, but overall, energy as a defensive sector should not be leading the charge. The XLY is starting to rebound a little bit off of those dramatic lows that it had put in over here, and this, of course, is a good thing. We are at the neckline of this pseudo double bottom. It's not the cleanest whatsoever. I will certainly give you that, and it would seem reasonable to me that we could expect a little bit of pullback here off of this set of highs. Because of that, and this also being a heavier weighted sector, I could see the market itself, the SPY, pulling back as well, and it ties in beautifully with the theory of the weekly high volume node that we saw. If we continue along here, what do we see in real estate? Again, a screaming move to the upside, confirming this as a double bottom. We are coming in for the back test of prior breakdown points, right? So to me, again, a reasonable expectation would be a little bit of a pullback here, indicating some downward pressure for the SPY. XLK, what do we see in this one? The heaviest weighted sector of them all, confirming the break of the double bottom in the SPY itself. Remember that in the SPY, on this day right here, the SPY actually printed up and over the prior sets of highs in here, whereas the XLK never did. We do not have that sort of discrepancy here in the break of the neckline overall. The SPY broke its neckline, as did the XLK. So this is actually confirming a better move to the upside overall inside of our marketplace. As of right now, just like the S&P 500, I would love to see this consolidate consolidate above the neckline of the double bottom. As long as it's above 138, 137.50, to me, this checks out as a healthy move inside of the tech sector, the most important sector for the SPY itself. So good look here in the tech sector. Continuing along, communications getting up and over their neckline as well. Again, it strikes me as a decent look here. We are looking for that next equal high, roughly up around 63. Could it pull back? Yes. Again, do we want to see it consolidate above that 59? Absolutely. Anything that rotates back down underneath does become slightly more cause for concern. Continuing along, utilities. What do we see in this one? A little bit more of that concerning look, just like energy, remembering that we had this nice little balance. It was playing nicely for us, and it's starting to break back out and get towards the all-time high. It's not quite there yet, and obviously it's got more work to be doing if it wants to break above that, like energy, but it's certainly, again, not the best indication for a better bottom in the SPY from a sort of psychology standpoint, risk on, risk off, and defensive sector standpoint. This should not be leading the charge. Next up, we get the builders, not builders. Sorry, I do it every time. It's just a bad habit. Materials, really lightweight sector. The fact that it's in the midpoint of the range, putting some upward pressure on the SPY, strikes me as healthy. We're not going to read into it too much more than that. XLV for healthcare, second heaviest weighted sector by market cap for the S&P 500. We know that it was relatively strong with the first higher low that was produced here on the daily time frame, breaking the neckline of the double bottom into the end of the week, and even closing above the midpoint of this overall range here on the daily time frame. An extremely good and healthy look for our S&P 500. Notice also the strong volume that came in on Friday, supporting the idea that there were a lot of market participants getting involved on this rally here. So far, a really decent look for the S&P 500. If it does pull back, anything that remains above that 131.25 is what we want to see here. And could it pull back? Yeah, absolutely. We've seen resistance here in the past. It was prior support. We hung up there for a lower high before that next leg down. I could see an early week pullback, which again supports the idea that we shouldn't be overly bullish here right off the bat inside of the SPY itself. XLF for financials, just a massive move to the upside in the Thursday and Friday sessions here. Double bottom has confirmed up and over the neckline. We are basically here for the equal high. This can afford a higher low pullback as long as we're above 34.25. It keeps risk on inside of financials, noting that a trend change is underway here. Slight concern in the volume tapering off here, but overall a decent look from a structural perspective so far inside of our financials. Industrials, what do we see here? Again, a really lightweight sector, but any upward pressure is still upward pressure for the SPY. As long as it plays nicely somewhere in this range, fantastic, not an overly concerning look. XLP for consumer staples really rebounding off of these lows in here. Again, we don't want to see it leading the charge, and it certainly is not doing that right now. As long as it remains nicely in this range here, but not breaking out to new highs, really good look here for our S&P 500. So overall, our sectors have improved considerably over the past week's worth of trade, and I really think this is evident inside of our ratio grid here. So in the top four, these are our risk-on sectors. Notice that the XLK is perking back up. It's not quite above that 50 SMA, the gold line here, but it is well off of these lows, and it's also above some of these prior highs. So steps in the right direction. I would love to see it improve by taking out the 50 SMA and starting to form a set of higher lows above to change the trend here. Again, don't get me wrong, the risk is currently that this turns into a descending triangle. That's sort of a terrible trend line, but you get the gist. Overall, the XLV, the chart itself looks fantastic as we just saw, and we're pulling into an upward sloping 50 SMA. Really solid look from the ratio perspective. The XLY is finding a solid V bottom. My concern here obviously is that this is the weakest of the big four here, and there still is a large distance from a downward sloping 50 SMA. So if there's going to be more work to be done, it's probably in consumer discretionary sector. XLV coming in for a higher low pullback above an upward sloping 50 SMA as of right now. This one to me has really shined through in terms of generating the turn, or really that indication that things are starting to perk up in our risk on sector. So I like that continued bullish look here in the ratio itself. Down at the bottom, notice the deterioration in a couple, not all, but a couple of these risk off sectors, indicating that obviously as these deteriorate, the more risk on sort of shines. So XLP pulling into that 50 SMA and still going sideways around it. We did not see an aggressive bounce back up towards the highs off of the 50 SMA touch. Down below in real estate as well, notice that we're just kind of going sideways and tangling up around the 50 SMA instead of, again, bouncing or breaking out of this range right back up towards those highs. The XLE, it's starting to curl down a little bit, but still, again, a lot of distance between the 50 SMA. Same thing with utilities. So overall, in the grand scheme of things, things are starting to show some signs of improvement, but we're not quite there yet for a full-blown reversal, full-blown bull mode back to the upside. And I want to be abundantly clear about that. Although in the short term, the momentum does look for higher, I am concerned that some things are not completely out of the woods just yet. Let's go back on over to our normal charts here and take a quick peek at the TNX, which of course is our 10-year rate. Notice that we are getting that head and shoulders pattern right here. Our neckline would have looked something like this. We have pure acceptance underneath that neckline right now. All I'm getting at with this, because of course we don't look at this through the traditional lens of technical analysis, is that we're going sideways and we're not marking new higher highs or higher lows. We know that that overall in the interest rate sector would of course be an improvement and a benefit, a tailwind to the tech sector, right? The lower the rates, the better the tech sector can perform. And the fact that this continues to just go sideways here and not make new highs is of course a good thing for marking some sort of market bottom, or at least improvement in the heaviest weighted sector, of course, the XLK. Let's get into some risk now. So VIX is of course what we want to be looking at here, the fear index. What's the market feeling like? It's still elevated, okay? And this is one of those things that has me slightly concerned that we're not all the way there yet for a major bottom. Now, if this does fall out of the box I've just drawn and come into that 2050 end support trend line, that would be a decent indication. But if it wants to find support here and just bounce around in this box some more, I don't necessarily think we're all the way there yet in the S&P 500 for a bottom. Another major red flag that I've been seeing is the VVIX itself. We talked about the major degradation of this on Wednesday underneath that 103 level. This is such a historic level. If I just grab some more time here, basically, this is the lowest that we've seen the VVIX, if I just grab 3 years, ever since the onset of the sickness, right? Look at where this has been. We're basically marking new lows here, and this is slightly concerning, just indicating that the volatility is sort of coiled up for a move in one direction or another. Now, don't get me wrong, this should perk up a little bit and come back into normal territory if the VIX itself starts to break down from its box that we've just drawn in over here, right? As long as volatility, meaning that this gets out of the range it's been trading in, that VVIX should perk up and go back into normal range. So again, if this happens, it should trigger a VVIX that perks back up and sort of, starts not to look so concerning. All right. So that's my major takeaway from there. A downside break would of course be good, but overall, it's still just indicating that there is some risk of a massive move either higher or lower in the VIX itself. And obviously, if it's higher, it means that this was just one of those bear market rallies that might have sucked some people in early. That's the VIX itself. For next one, I'm getting sort of ahead of myself here. Next one that we want to look at is the market internals. And this, again, would strike me as something we want to pay attention to early on in the week. The main takeaway here, and I've talked about it a number of times on the channel in the past, is the over-correlation on the prior Thursday and Friday session here. Usually, market cannot sustain moves up and over positive 2,000. It means everything across the entire New York Stock Exchange was being bought up. If there's even a little bit of a, sort of pullback, or some people sell some of the assets that they were buying on the Thursday, Friday session, that would lead to an advanced decline line that is much closer to the midpoint of this overall range. And by the way, I've got a video. If you're not sure what we're looking at here, check out the link in the top right-hand corner. I'll link it up there. It's going to describe the screen here and how you can use it to make better intraday trading decisions. A couple of things to pay attention to. Here's a few scenarios. On Tuesday, if the advanced decline line opens in the midpoint and we hold for bullish consolidation in the spike that we pointed out from the market profile, that would strike me as a bullish indication. If we do this around the midpoint in the advanced decline line, but the market's falling off a cliff into Thursday's session range, that would strike me as much more concerning. And again, that the buyers clearly got way ahead of themselves on the Friday session. So that's how I would use that as sort of an indication here with your market internals. Next, but not least, we certainly have for our broad market, at least the SPY, our SPX A200R. This is the percentage of stocks trading above their 200 simple period moving average. What do we see here? The line has actually perked back up. It is technically bounced off of the top of our yellow box. On a weekly time frame perspective, you would notice it dipped a quick toe back in, and now we're back out. But overall, this is starting to bounce from the area where we would say it would be reasonable to expect some sort of major market reversal from here. We've seen this in the past, right? Here and here led to a big market reversal. Here Big market reversal. This, of course, is the onset of the sickness. Big market reversal out of it. We're not quite all the way into the box, but on the weekly, as I just showed you, we did technically go in. Okay, so not there on the monthly, but on the weekly, certainly, and we could start to see a bounce from that. Is it time for a big market bottom? Potentially here, but again, as we pointed out, there are a number of risks so far that wouldn't have me feeling hunky-dory just yet. Again, steps in the right direction, but we're certainly not all the way home for now. Let's quickly flip this on over to our regular sort of look here, and we will just quickly round out the broad market. Thank you so much for sticking with me through this entire presentation. What do we see in the QQQ? Very similar to what we just discussed in the SPY itself. We closed well above the weekly expected move from last week. It was somewhere in here, right at and underneath the resistance trend line. Notice that we've closed above that, obviously, and also above our daily double bottom. So steps in the right direction, certainly for a big market reversal. We can remove our secondary resistance trend line. The primary is coming from in here. Certainly does not strike me that we're going to get there on this upcoming week's worth of trade. Upside target 315.50. It's also not quite the top end of the weekly expected move. So if we do see some of that rally, we could come short of the top end and fall into that resistance instead of what the expected move is measuring up towards, let's just round off there and call it 319. To the downside, again, we do want to see consolidation hold up above our 305.50 here, the neckline of the double bottom in the QQQs. If it does pull back, the next higher low has to be off the low end of the weekly expected move for something that does this over time and forms a higher low above 297.50. Anything underneath that does strike me as starting to become more concerning. Obviously, again, if this is just a fake bear market rally here, anything that rolls over immediately and gets price acceptance in these areas strikes me as a bearish implication, and maybe we do some tagging up of those virgin points of control that I had pointed out earlier. So overall, yes, momentum is pointing for some continuation higher, but could we see some consolidation and slowdown around these areas of resistance? Absolutely, I would be watching out for that into this upcoming shortened week. Next but not least, we have Russell 2000, small caps here, IWM. What do we see? Perhaps the best looking chart of them all. Why is that? Well, not only did we produce already a higher low double bottom, so we do have a support trend line in play. We've closed above the double bottom neckline, and we've also closed inside of this area of consolidation from right around in here. To me, a better risk on signal here inside of IWM. A significant amount of work has been done in the small caps. So going forward, of course, we do want to see it in an ideal world, hold up above 184.50 and get some continuation up towards the top of that 50 SMA and weekly expected move. That's 193.50. On your upside for the target this week. If we pull back, I still wouldn't be overly concerned if we form a higher low above 179. Notice it would be above the breakout point that we were discussing in the midweek market update last week, and also well above our support trend line to the tune of roughly $5, right? So overall, I really like any pullbacks here inside of IWM that do form a higher low and potentially continue this trend to the upside. The risk for downside would, of course, be if we break down underneath 179, so something that does this and this into the end of the week, breaking the support trend line. Obviously, that's a change in tone, and this, of course, would have been nothing more than a fake out to the upside. But currently, given the current state of the chart and all of the information we have in front of us, I would be favoring any sort of pullbacks that happen here and then continuation, or if it is a little bit deeper, 179, big break and retest there, I would be watching for support and reversals off of that level for a move back higher, at least for an equal high in here. That's been the broad market. Thanks for sticking with me. Let's get into these companies. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. And with that, let's get right into Apple. Clearly, breaking out of a 4-day balance range here. We had inside bars on the Tuesday and Wednesday session. Thursday, Friday, big breakout with some follow through into this most recent high here. So overall, this is supporting and following along with what the market is doing overall. And we are looking for continuation. Remember that we have a considerable amount of consolidation, and we have just day one of the overall breakout to the upside. So can we continue here? Yes, absolutely. There should be enough pent-up energy in this box to see that continuation. Another bullish indication here in Apple is the fact that we have an unfilled gap underneath us, indicating that the sellers could not step up and take care of that poor structure underneath us before the buyers returned back into control and taking us for a massive rally essentially on the Friday session. Overall, looking for a continuation. 152.20 is such a pivotal level. Remember, we've discussed this in the past so much. I would watch for, again, maybe the pullback to come off of that and then a higher low to be formed at or around 148 here inside of Apple. So overall, short-term outlook is for continuation. We want to see a higher low form somewhere in here. Overall, what I've just drawn in is, of course, a bull flag, and a breakout of that gets us into our resistance trend line. Anything to the downside, first look is for the gap to fill and then reverse out of it. That would be your pullback scenario if we never see continuation higher in the first place, and anything that falls back down underneath the bottom end of the gap, which is 144.25, puts us back into this period of consolidation. What do we have? A look above and fail. Target technically should be the bottom end of the range here, roughly 137.50. So overall, short-term outlook is for higher, but we have downside scenarios as well. Netflix is up next. This is a very simple chart to follow along with. We have a break finally of this balance area here on the daily. I love the lower wick that was put in on the Friday session, indicating that the structure has been filled. We back tested the breakout point at 190, and we closed the day at the highs of the day. So overall, again, looking for continuation here, noting that we're breaking out of a considerable balance area. The target overhead is 202.25 in the short term. If and when we get here, if a higher low is produced, as long as we're above 190, that preserves the higher low sort of theory and the fact that we are above all of this pent up demand that's supporting at the top end of the balance area and breakout points. So overall, 190 critical watch to the downside. We want to remain above that to be bullish, and 202.25 is your upside target. Anything that fails back down underneath 190 early on in the week, it would probably have to be the Tuesday or Wednesday session, puts into play a look above and fail. Again, your target, just like we just discussed in Apple, would be the bottom end of the range here at 176.50. Continuing along, Tesla. I was absolutely wrong about Tesla. I am 100% okay with admitting this. I thought the downtrend was going to provide some significant resistance at that 700 on the back test there, and as we can clearly see, we broke right back up above it. So a couple of things I'm watching for in Tesla to start to get me in the mindset of looking for longs now. Obviously, we can see a little bit of continuation into that 780, but really watching for a pullback from there. As long as the higher low happens above 700, fine, I can start to view this as a bit of an inverted head and shoulders. Of course, your better neckline breakout point would be that 780.75 at that point in time. And overall, I would look for a bump in the road at 823, but overall, again, that target should be 861 on the move back higher. So that's how I'm thinking about Tesla. If it fails down underneath 700, obviously, again, this is a bit of a bear market rally, not really materializing, and underneath 700, you would look for this equal low for to get repair at 625. Notice how the two back-to-back candle lows are dead equal. If we come back to it, I would expect that that would break. It might require an initial test into it, lower high, and then a breakdown after it, something that would look like this into the end of the week. That's the bear case scenario, but as of right now, as long as we're above 700, again, looking for that inverted head and shoulders case to play out. AMD is up next. What do we see in the chip maker here? Currently breaking outside of the really long balance period that we've been stuck in for quite some time. We had the first fake break right around in here, but this week on Friday, we closed the weekly candle above the 50 SMA as well as that godforsaken 100 psychological level. We're not quite at the resistance trend line, so again, I could see a little bit of upside continuation. Pullbacks in this one want to, of course, hold on to 100 as a retest level, and then anything deeper than that, if it does decide to go back into the range, would have me feeling quite concerned. I would not be looking for bottoms in this range overall, and instead only be paying attention to the support trend line. Low, higher low. There's potential for a higher low here, but again, I wouldn't be fishing for the long at this area. I would wait for it again to, at this point, probably break the really significant resistance trend line coming from the all-time high in AMD. You can see all of these touches. We are yet to breach it. So again, a failure of 100, that's fine. Let it consolidate further. And if it wants to break in the bullish direction, it's got to be the trend line at this point in time. To the downside, a break of the support trend line obviously just gets us back to the low end of the range at 85, not the primary look into the early part of this upcoming week. Facebook is up next. What do we see in FB? Zooming in on this one, it filled the entire gap here, which I thought was an indication of weakness in the midweek market update. Remember that this was a partial move into the overhead gap, and really it took the Thursday and Friday session to actually close it all the way. As of right now, we're kind of in this really sloppy area inside of Facebook on the 30-minute time frame, which, bear with me, I'll have to flip this to the 30 for a second. There you go. You can see how this is a critical level of resistance from in the past around 195. There is potential for a breakout to lead to 202.15, but overall, based on the amount of work that's been done already, I'm not sure I would be chasing it long here in the midpoint of this overall range, even though it is technically a resistant breakout level. Instead, I think a wiser play in Facebook might be to watch for this support trend line to come back into play. We've gotten certainly extended from it to the upside here, and if we come back down in for a higher low and then reattempt 195, that's probably your higher probability long for an entry here to get us into 202.15. So that's the setup in Facebook, probably easier visualized there on the 30-minute time frame. Any breaks of that support trend line, and again, I would probably have to reevaluate the chart on what that break looked like. Are we coming back down into these lows? I think it's also fairly hard to pick out a short here inside of Facebook currently. Next up, we've got NVIDIA. What's going on with this one? Clearly, I do think the earnings saved the day inside of NVIDIA. We had a really reasonable earnings announcement here. It did not completely tank NVIDIA, as have many of our other tech companies over the past couple of weeks. So this save, if you will, on the Thursday session really spurred the market reversal back higher. Really interesting here. We've closed outside of this balance area and inside of this balance area from right around in here. I do think we might be in store for a little bit of pause here, noting how, I don't want to say extended, but just how much work the buyers have done, so to speak. If you look at the volume here, really nice increase on the earnings day and then a slight taper off on Friday. I think we could start to slow down in this overall area, not only noting that we have overhead supply here, but the buyers have also sort of exhausted some of their resources, moving from bottom all the way to top and some of this most recent range. In terms of overall pattern, yes, don't get me wrong, the double bottom has triggered a break up and over the neckline, and we should continue to have a long bias here, but we might want to look for a little bit of consolidation first, very similar to what we just discussed in Apple, a bull flag to build out, and then a break to get us into that 199 next upside target. So that's NVIDIA overall. If we fail back down underneath 182.25, that sets into play the look above and fail, and I would look for at least the midpoint of this overall range here. 175 would be my next pullback target. Next up, we've got Softy, Microsoft. What's going on in this one? If we take a quick zoom, there we go. What do we see? Close above the daily resistance trend line. So really strong indication for a bottom here inside of Microsoft, noting that we now have higher highs. We've broken the downtrend, and also we've closed above the neckline of the double bottom. So a number of things do point to improvement here inside of Microsoft, but just like everything else, I would be looking for a little bit of consolidation, maybe a day or two first, and then continuation to maybe get us into that 50 SMA and overall bottom of this range. As those things start to coincide, that will provide a super resistance roughly around 278.50 on your upside target. Any pullbacks at this point in time probably just want to come in and fill this slight unfilled gap underneath us around 267. It's not really big enough for me to mark off with yellow lines here today, but nonetheless, anything that remains above, again, builds out that bull flag scenario, and we're looking for higher after that. Anything underneath that gap fill, it's all about here at 261. Would that produce a higher low? Yes, absolutely, if we bounced off of it, but notice also we would be back down underneath the resistance trendline, which again would have me feeling just less confident overall about this being the true bottom inside of Microsoft. So things to be thinking about. Yes, overall, the same theme for the entire video is that we are looking for higher out of the gates, and overall maybe some consolidation as well. Downward scenarios will take some time to pan out to really prove to us that this is in fact a bear market rally that will turn around over time. Last but not least, the beast here, we've got Amazon. We're coming up on that split date. 6/6 is around the corner here. And again, Amazon 20 for 1 will be really interesting to see what happens to the options market and whether or not that will become more liquid. Nonetheless, in terms of pattern here, right at the neckline of the double bottom, it did not technically break out up and over it on the daily time frame. 3 days of price action screaming from the bottom of the double bottom all the way to the neckline at the top. If we see a pullback here overall, the main area I'm watching is roughly 2200. As long as we're above that inside of Amazon, I think we're making steps in the right direction, and eventually that neckline will break at 2300, about $100 increments here inside of Amazon. And of course, our next resistance, the target overhead, is 2400, sticking with that theme of increments of 100. After that, this will be a breakout point to carry forward at 2520, noting that on the initial earnings gap down, we had two equal highs there. We had equal lows as well. People were prepping for the long in here in my estimation. It never broke out. So really carrying that forward level as carrying forward that level as a strong one into the future here, as this split potentially spurs some buying activity in Amazon. A lower price point might attract some new investors. We'll ultimately have to see. Nonetheless, that has been our core list of companies. Thanks for sticking with me. One more section for our trade ideas, and then it's time to enjoy the weekend. Quick reminder to hit that thumbs up button, the bell button, the subscribe button, all those buttons YouTube tells us to tell you about, and let's get right into these trade ideas, kicking things off with Citi. This is a repeat from our Wednesday video, but I thought it was worth mentioning again. 54 is your breakout point coming from prior support, which has turned into resistance and was resistant on the Thursday-Friday session. We know that financials are looking incredible here, breaking out over their double bottom neckline and going on a nice rally. So if Citi can follow suit, being in that sector, we're looking for the rotation here into roughly 58. We did mark a higher low on the Thursday and Friday session, 2 days back-to-back of consolidation. So to me, it would be reasonable to expect a break of 54 to have some follow-through early on in this upcoming week. Not really interested in the trade long if we never take out 54. Certainly not interested if we break down underneath 53. Next up, we see MU, which really has a look more like AMD. Notice that we do have this consolidation range. It unfortunately has not been able to break out of the top, but maybe fortunately for us, that means a trade setup could be on the horizon here. Overall, I want to see it get out of the range that's up and over 74.60 for continuation into our next resistance level here at 80.50. 200 SMA does stand in the way, but overall, I think this consolidation period has been long enough, and this is well within the range of a range double that we should be looking at that 80.50 for a target. Overall, we do have a gap to contend with underneath us. If we consolidate up here, great, the trade is on for upside. If we fill this gap and move underneath into the big range day from Thursday, I would not be as interested in this MU trade. Next up, we have Upstart. UPST is the ticker here. We mentioned this on a live stream long ago when we were working our way initially into this earnings gap down from the bottom side up, namely in this section of the chart right here. What I want to point out about it and why there's a trade idea brewing here is that we clearly have a higher low that's been developed. We're coming in for the equal high, and where was the location of the higher low? None other than right at the top end of the initial gap down from earnings. So I like this holding up for upside. As we move up and over 51.68, we are filling the remainder of the gap, and our target should be up towards the gap close at 76.25. Also, daily 50 SMA, the blue line, should meet us there nicely for super resistance if we get a move higher out of the gates. Obviously, the longer we go sideways down here, the more this has the chance to come underneath and provide resistance sooner than that 76 quarter target. But overall, looking for upside here inside of Upstart. Next and last, we see Boeing, BA. This thing has been, in my opinion, unjustly beat up here, and it is starting to rebound a little bit higher. Nonetheless, it has not broken out up and over the neckline of its pseudo double bottom. It's a lower low double bottom, so not as confident as a higher low double bottom, but nonetheless, up and over 132.80, you're looking for rotation through this thin structure. Again, this here is what also makes the trade fairly attractive. The fact that we don't have a lot to contend with until we get into 146 quarter as our next upside target. So Boeing up and over the breakout point, attractive for potentially continuation or reversal rather into 146 quarter. Overall, that's going to do it for this week's episode of the Weekly Watch List. If you enjoyed the video or learned anything new during any point of today's video, feel free to let me know down below in the comments section or by giving the video a thumbs up. With all of that being said, I wish you a green trading week, and don't forget the market will be closed tomorrow.